What is amortization of intangibles? Amortization of an asset refers to the process of spreading the cost of an intangible asset over its useful life, similar to depreciation for tangible assets. This accounting practice allows businesses to reduce their tax liability by recording the amortization as an expense on the income statement. Intangible assets, such as licenses or patents, are recognized when their cost is measurable and they are expected to generate future economic benefits for the company. To capitalize an intangible asset on the balance sheet, a business must be able to measure its cost, have legal rights over it, and expect future economic benefits, like an increase in operating revenue. While some intangible assets are purchased externally and recorded at cost, others can be developed internally, particularly through research and development. However, expenses during the research phase are not capitalized but recorded as expenses. Once the asset is in development and meets certain criteria, its costs can be capitalized. Intangible assets are measured either at cost or fair value, depending on whether there is an active market for the asset. The cost model records the asset at cost minus accumulated amortization and impairment losses, while the revaluation model uses fair value minus these deductions. Amortization is typically done over the asset's useful life using methods like the straight line, accelerated, or units of production method. Intangible assets with an indefinite life are not amortized but are tested annually for impairment. Goodwill, especially in business combinations, is a contentious topic. Unlike other intangible assets, internally generated goodwill is not recognized on the balance sheet, but purchased goodwill is, and it's subject to annual impairment tests. Critics argue that impairment testing is subjective and often delayed, prompting ongoing debate about whether goodwill should be amortized instead. Prior to 2004, goodwill was amortized over a period not exceeding 20 years. Proponents of goodwill amortization argue that it simplifies accounting, avoids the complexities of impairment testing, and provides a steady decline in the recorded value of goodwill, reducing fluctuations in reported profits.